Welcome, curious minds, to another deep dive. Today, we're embarking on, well, an incredible journey through technological history. It's a journey that spans centuries, really, and reshapes entire economies. Our mission, to unpack how these groundbreaking inventions truly change the world, how the money flows into them, and why the path to success is almost never a straight line.
Yeah, and we're pulling our insights today from a really fantastic book, Engines That Move Markets.
Yeah.
It dives deep into 10 sort of pivotal moments in tech history. We're talking everything from 19th century British railways right up to the internet age. It's just a fascinating look at how industries rise and fall, fortunes are made and lost, and how surprisingly often the past echoes into these headlines.
Right. So if you're looking for maybe a shortcut to understanding these forces, the ones that have consistently driven markets and reshaped society, well, this deep dive is for you. We'll be pulling out the most important nuggets of knowledge, those insights, and hopefully plenty of aha moments along the way.
Okay, let's unpack this. So if we look back, a lot of people point to the 1840s British railway mania. They call it the world's very first tech bubble. What's really striking is how profoundly railways didn't just, move people faster. They genuinely reshaped society, reshaped wealth. They basically became the new economy of their time. Absolutely. They created whole new financial dynasties. You saw this huge shift in wealth, moving away from the old landed gentry, the agrarian aristocrats, towards this new class of industrialists.
And that really forced the financial markets to adapt, didn't it?
Oh, completely. Before railways, most investment was pretty safe stuff, government securities, things like that. But these railway projects, they were massive, hugely capital intensive. So investors, they didn't just want a safe return anymore. They wanted, a slice of the profits, a piece of the action. And that drove this huge shift towards equity funding. People buying shares, getting involved in what felt like a gold rush.
You can almost feel the frenzy, right? But here's where the parallels to, well, to our own times become almost uncanny. The source calls these railway shares highly geared instruments. Just imagine putting down a tiny payment up front, maybe just 5%, but that controls a much larger investment.
Right, massive leverage.
Exactly. That small payment gave investors this huge stake, multiplying their potential gains or their losses maybe 20 times over.
Wow.
This kind of leverage, combined with just boundless optimism, it drove prices to completely unrealistic levels, way beyond any rational value.
A bit like NASDAQ in 99-2000.
Very much like that. It really makes you wonder, doesn't it? If we see that kind of euphoria today, are we actually learning from history, or are we just, recognizing the same old symptoms?
Well, I think the real insight here isn't just that bubbles repeat. It's how those human drivers, that collective delusion, the FOMO, the fear of missing out, they seem to play out almost identically, whatever the tech is. And the boom, inevitably, it deflated. Why? Over-leveraged investors, wildly optimistic forecasts that just ignored competition.
Hard fraud, too, right?
Oh yeah, outright fraud, plus a changing economic environment. Even a seemingly small thing, like the Bank of England raising interest rates from 2.5% to 3% back in October 1845, that could have been a big factor in popping the bubble. It really raises that question, does history give us a blueprint to spot future failures? Or is it just a mirror reflecting our, persistent human nature?
And it wasn't just the financiers caught up in it all.
Yo.
The book says the railway mania permeated society. We're talking duchesses soiling their fingers with, those provisional share certificates, and old maids inquiring with trembling eagerness the price of stocks. Even a respected paper like The Economist was warning people about the speculation.
Right, cautioning against it.
Yet, here's the kicker. Despite the undeniable, solid economics underneath it, all railways were transformative. The source tells us that actually investing in them, it wasn't rewarding for 50 years after the bubble burst.
50 years?
Yeah, it's a crucial point. Even with truly game-changing tech, that first-mover advantage can just vanish, especially when capital is easy to get and there aren't clear barriers to stop competitors jumping in.
And that leads us to another really powerful lesson, doesn't it? How often these breakthroughs are initially just underestimated, especially by the big players they threaten. We see this so clearly with the telegraph and the telephone. Western Union, they were the dominant force in the U.S. telegraph business. By the late 1870s, they were formidable. 7,500 offices, nearly 200,000 miles of cable. They'd grown huge thanks to the Civil War and their links with the railroads.
Yet, they made what has to be one of the most, short-sighted comments in tech history. William Orton, Western Union's president, famously turned down Alexander Graham Bell's telephone patents. for just $100,000 in 1877.
Incredible.
And he asked, what use could this company make of an electrical toy? An electrical toy. But you have to wonder, from his perspective then, was it just blindness? Or were there maybe strategic reasons they just couldn't see the potential immediately?
That's a great question. Because Bell and his partners, including his patent attorney Gardner Hubbard, who crucially insisted on meticulous record keeping, they faced a massive uphill battle. They were up against the incredibly well-financed Western Union. They fought over 500 patent cases.
On his hundred, wow.
Yeah. And Western Union didn't just sit back. They launched their own company, the American-speaking telephone company. They brought in top scientists like Thomas Edison and Elisha Gray, people capable of making superior apparatus. They even tried smear campaigns. But in the end, Bell's patents, because they were so meticulously documented, they won out. It just highlights how critical patents and, a smart legal strategy can be in turning an invention into actual commercial dominance.
So Bell's company, which later became AT&T, it grew to completely control the telephone market, and with incredible profit margins, right? Over 40% early on.
Huge margins.
They used pretty aggressive tactics, too, banning equipment that wasn't from Western Electric, refusing to let independent phone companies connect. But doesn't that kind of dominance, that success, sometimes create its own blind spots? Doesn't it make it harder to spot the next disruptive thing?
Oh, absolutely. That dominance, while it was hugely profitable, it eventually brought AT&T into conflict with the authorities. And maybe more importantly, it fostered this risk-averse attitude. They got so worried about monopoly charges that they actually held back from fully jumping on new opportunities, things like radio and broadcasting.
So their own success kind of stifled them.
In a way, yes. It's a really striking example of how being dominant can lead you to miss the next wave, partly out of fear of regulatory backlash. And it's interesting, isn't it? The telephone very quickly found uses beyond just talking. Direct marketing to affluent households.
Oh, the first telemarketers.
Pretty much. And it led to early consumer annoyance, too.
Yeah.
By 1909, people were calling it a nuisance, an abuse of the telephone privilege.
Huh. Some things really don't change, do they? Okay, so from the explosive, almost chaotic growth of communication voice conquering distance, let's shift focus. Let's look at the equally revolutionary power of light. How did another established monopoly, the gas industry this time, deal with this new challenger, electricity? And what familiar battles over standards and consolidation played out there?
Well, back in the early 19th century, the gas companies, they were pretty comfortable. They had fixed-term contracts, exclusive rights, basically a monopoly. And that led to complacency and, predictably, consumer resentment.
Resentment. The book mentions people training dogs.
Yeah, training dogs to bite gas meter inspectors just to stop them taking readings. That tells you something about customer relations back then.
Wow, that's quite the feedback loop. Makes you wonder what modern tech might get that kind of visceral reaction today.
It really does, and it brings up that critical question again. Is it just inherent in dominant companies to underestimate threats? Or is it more about their existing investments, their business model?
Yeah.
Along comes Thomas Edison, a prolific inventor, over 1,000 patents to his name, and he's aiming to create a practical electric light. Just his early announcements were enough to cause a precipitous fall in gas company share prices.
So the market saw the threat immediately.
Some did, and shrewd investors, people like the Vanderbilts, who'd already seen how new tech could disrupt things with Western Union, they quickly invested in Edison's venture. Interestingly, they even did it through Western Union sometimes, apparently to avoid undermining publicly their existing gas company interests, hedging their bets, essentially.
That's clever, diversifying risk without showing your hand. But Edison, brilliant as he was, he had his own blind spots, didn't he? The whole AC versus DC thing.
Oh, definitely. He separately resisted alternating current, AC, which George Westinghouse was championing. AC was technically superior for long-distance power distribution, but Edison stuck to his direct current DC system. The source puts it down to his scientific ego, this unwillingness to accept that this dictum might also apply to others.
Even a genius can be blinded by their own conviction, I suppose.
It seems so. And crucially, this whole new electricity industry was incredibly capital intensive. Companies faced financial difficulties. Consolidation was pretty much inevitable. And that's where figures like J.P. Morgan became central. He orchestrated the merger of Edison General Electric with Thomson Houston in 1892. That created General Electric, GE.
The GE we know today.
The very same. And the new GE immediately had to face a substantial write-down. $14 million in 1894. basically acknowledging that some of those prior capitalized costs, those earlier investments, weren't worth what they thought.
The finance was key.
Absolutely. Access to capital, that strategic financial backing from people like Morgan, it was just as crucial as the inventions themselves in shaping how the industry developed.
And what happened to the gas companies? Did electric light just wipe them out?
Well, interestingly, no. They definitely lost the lighting market. But they survived, and actually even prospered, by diversifying. They pivoted into heating and cooking, leveraging the pipes and infrastructure they already had. As the source says, the technological defeat was only a partial one. They adapted.
That's fascinating. So, having seen these patterns, the bubbles, the missed opportunities, the resistance, the consolidation play out from railways to electricity, let's fast forward. Let's jump into our own time, the digital era. How much of what we've discussed holds true when the product isn't physical infrastructure anymore, but, well, information itself?
Yeah, it's incredible how fast the landscape shifts in digital technology.
You go from these massive mainframes needing government funding to personal computers in pretty much every home, and now services that appear free but are actually harvesting our data.
Right. And it started, much like railways needed big capital, with government needs driving early computing. Think the U.S. Census Bureau back in 1890, Hollerith's mechanical aids sped things up dramatically.
Or military applications like ENIAC, which was unveiled publicly in 1946.
Exactly. But the real game changer was the transistor, invented at Bell Labs. That transformed computers. Suddenly you could get rid of those huge hot vacuum tubes. It overcame the previous limits on scale. And that paved the way for IBM's era of dominance, really cemented by their System 360 launch in 1964. It unified their whole product line.
But that dominance brought its own problems, didn't it?
It did. 13 years of regulatory scrutiny for alleged market abuses. It shows the challenges that come with being number one.
But then new players started chipping away. Digital Equipment Corporation, DEC.
Yeah, DEC. Founded by Ken Olsen and Harlan Anderson, they carved out this niche with powerful but smaller, cheaper machines. Their PDP-1 cost around $125,000.
Still a lot, but compared to mainframes.
Exactly. Mainframes were over $1 million. So DEC targeted these sophisticated customers who needed computing power but couldn't afford or didn't need a giant mainframe.
And then came the PC revolution, driven by the microprocessor.
The Intel 4004 microprocessor specifically, which, believe it or not, was initially just a sideline product for Intel. It only cost them $10,000 to get the exclusive rights back, and it became the absolute cornerstone of the PC industry.
Wow. What prompted that shift?
Well, partly the calculator price wars in the 70s. Companies like M-ites were getting squeezed and needed new products. That led them to create the Altair, one of the very first personal computers.
And Apple's role.
Apple, with the Apple II in 1977, really focused on ease of use. That was key. And they bundled software like VisiCalc. VisiCalc was written by Daniel Fulstra and Dan Bricklin, who apparently just liked the capabilities of the Apple computer. It became the first killer app.
But it was Microsoft that really took over on the software side.
Absolutely. IBM made this crucial decision to allow clones of its PC. That opened the door wide for Microsoft's operating system, MS-DOS, to become the industry standard. It effectively drove a wedge between hardware and software, as the book says. Microsoft just emerged as this software giant with profit margins that only small specialist niche players were able to match.
And then the internet. It started as a military project.
Yeah, ARPANET, spurred by Cold War fears. But it transitioned to commercial use around 1995 when the NSFNet backbone was privatized.
And companies like Cisco jumped in.
Right. Cisco Systems. Started by a frustrated Stanford couple, Sandy Lerner and Leonard Bosak. They focused on the infrastructure, the routers, the iOS software. They benefited directly as the network just grew and grew. And it's amazing, they were reportedly rejected by 75 venture capitalists before Sequoia Capital finally put in $3 million.
75 rejections. Persistence pays off.
It certainly seems so. And this whole cycle, this consistent theme of challenge, control, disruption, and it just keeps evolving, doesn't it? You had the dot-com bubble where Netscape had that early first-mover advantage but got strangled by Microsoft. You had AOL, a huge pioneer in internet growth, making that infamous merger with Time Warner, later called the biggest mistake in corporate history by Time Warner's own CEO.
Ouch.
And then came Google and Facebook. Their models were capital light. They didn't need vast factories or railway lines.
Right, different kind of engine.
Exactly. They monetized user data through advertising. They became the new titans. And this ushered in just a massive shift in advertising, a paradigm where, as the source notes, consumers cannot be persuaded to pay for the services directly. Instead, we provide valuable data through our usage. We become the users of what the source calls byproduct companies. Our data, our attention, that's the product being sold.
So after that whirlwind tour, what does this all mean for you, the listener, navigating today's, well, incredibly rapidly changing world? As we see in the history of technology and markets, it's a powerful reminder. The innovations themselves are truly transformative, yes, but the financial outcomes, the commercial success, that's rarely predictable.
Yeah, and a really striking observation from the book is how often the experts of the past just derided the very breakthroughs that would reshape everything. Why?
Yeah.
Because these new technologies challenge the existing order. And that makes you ask, doesn't it? Are we experiencing similar biases today? Are we maybe failing to see the next big shift because it just doesn't fit our current way of thinking?
We've seen giants, titans like Western Union, IBM, face challenges from completely unexpected corners. And we've seen the consistent importance of, well, not just brilliant ideas, but also access to capital, sharp business strategy, and sometimes, let's face it, just plain luck.
Definitely luck sometimes.
That first mover advantage, it can be so fleeting. The true winners often emerge long after all the initial hype has died down.
And maybe, connecting this to the bigger picture, the most profound lesson here is simply about humility. Humility in the face of innovation. It's quite a striking parallel, isn't it? Just like those old railway barons consolidated immense power, today's capital-light giants, these byproduct companies, they raise very similar fundamental questions. Questions about ownership, control, governance. What does it really mean for society when our data, our attention, becomes the core commodity and just a few companies wield such unprecedented influence over it? That's something that's still playing out.
It really makes you think, doesn't it? Especially about the nature of investment in these transformative times. Alasdair Nairn's research, which the book draws on, strongly suggests something quite provocative. Is it possible to generate substantial value as an investor, not necessarily by trying to pick the winners of each tech revolution, because history shows that's incredibly hard,
Right.
but maybe instead by identifying and betting against those companies which are almost certainly bound to lose?
Betting against the losers, not picking the winners.
Exactly. Something to mull over until our next deep dive.